So, Joachim, can you please introduce yourself?
Sure. So I'm Joachim Nahem. I'm the CEO of Position Green. I spent about the first 12, 14 years of my career with the United Nations, including what we today call the Sustainable Development Goals. I decided to go into the private sector and started a consulting company on ESG, working with a lot of the leading Nordic corporates and investors. And then my company was acquired along with Position Green about a year ago. And that is the formation of a one-stop shop on ESG, helping both investors and companies on navigating the very quickly developing ESG space.
Definitely.
Through software and advisory. So that's what we do as a company.
Perfect. So how can investors create value and manage risk through the portfolio of ESG data?
So I think this whole idea of creating value has been a little bit underappreciated because so far ESG has been a lot more about compliance, right? So you have to get this information, you have to do this because there's some new regulation coming, or this LP is asking for this, or a customer, etc. So it's been very sort of focused on just doing it without necessarily seeing what the value is. And especially for companies, including portfolio companies, don't always see the value of doing it. It feels like box ticking or compliance, like it would be for getting receipts for financial audits, right? So I think, when we can try to shift this, collecting all this ESG data and see that there's actually value in it to improve performance. And by improving performance, you're improving competitiveness. You're essentially making your company better positioned for the regulation that's taking place, but also for how capital is being allocated and how valuations will in the future take place, where it's looking at essentially, are you future fit for what is going to be a more sustainable world? So I think when we can take some of this data that we're collecting and actually using it to drive performance and drive strategy more, I think that's when it becomes really exciting.
Okay, thank you. What are some of the challenges ahead in making ESG data actionable and reaching the 2023 targets?
Yeah. So I think what we spend a lot of time at Position Green on is helping our customers understand what is material, because this ESG space has become so big, right? Just on the environmental and climate side, we're talking from everything from emissions to biodiversity, then you jump to human rights and diversity of people, and on governance. There are a lot of aspects there. And you put this all together and it becomes a little bit overwhelming. And there's so many disclosures and there's so many things. So what we try to do is help companies focus on what's actually material to them. Where is your footprint? What are your stakeholders actually asking for? So once you can kind of narrow it down a little bit more, you can then make more actionable KPIs from it. You can actually say, okay, so I need to focus more on emissions in my supply chain. My own emissions are minimal. I have an office of 30 people. So what we do in that office is maybe not that material. It's about where my money goes, or it's about the suppliers I use. So when you start focusing on that, you get KPIs which are more actionable and actually change the performance and thereby the impact of what you're doing. So I think that is a challenge, is first to narrow it down, then to make it actionable and drive performance, and that people understand, what do I need to do to move the gauge on this? So we need to make it more tangible because it's still very abstract. Most of this is going in reports that very few people read. It doesn't actually change the way we do things, or it definitely doesn't inspire people. So we need to really transform this. And this is also our objective as Position Green, is to make this more tangible, make it more actionable, have sort of dashboards and have strategies that are data-driven from your own sustainability footprint.
Yeah, so it's not only, as you said before, regulations and all of that, but actually making some actionable changes and decision for the organization.
Yes, and I think, on the regulation, it does feel like a lot of compliance, but at the same time, there are some very valuable exercises or valuable data that will be done through compliance. So this concept of double materiality, which SFDR and what's called ESRS for companies, you have to look at double materiality. Means you have to look at, what does this mean? What's the impact for my company? But what is also the impact on people and nature, whether independent of my bottom line, how am I impacting people and nature? when you do that exercise, your products and your services are put in a different light. So it sometimes can be a little bit of an existential exercise because you realize, well, maybe, I'm doing something that's good for my company, but it's bad for nature and people. And when you disclose that, it's also then shared with stakeholders, and both the perception and the value of your company may actually change.
Yeah, I mean, definitely. That's a very good point, as you're saying, because sometimes we're extracting all this information and data, but we're not looking at what is the impact of that, what the company is doing for the environment, as you said, for the society. So again, looking at it from different perspectives, right? We're collecting this data, collecting this information, but actually finding meaning in it, in this data and this information that you're gathering, and not only for company and the KPIs and that, but as well for the society, which I think sounds very interesting.
And we're seeing the same thing, obviously, when we help companies on taxonomy reviews in terms of understanding how much of their revenue is green according to the EU taxonomy definitions. And that not everything has been defined in terms of thresholds and economic activities. But again, your company looks very different, and whoever's investing in your company, if that's coming from a GP or indirectly from an LP, that information becomes quite valuable because it says something about where you are now and your future revenue, green revenue. And that again is going to be used as a metric also to evaluate the investors. How much of their money are they actually putting in what we define as green activities in the EU and more broadly?
Perfect. So do you see any trend or shift of LPs towards more strict ESG due diligence when allocating capital to fund managers?
I think we are seeing greater awareness, but I think in practice, we're not yet seeing that big a change. And this has, again, a little bit to do with regulation, that these are pending regulations. Everybody's getting busy. And of course, this SFDR definition of Article 8 and Article 9 is obviously driving a lot of the thinking and the due diligence of LPs. But again, it hasn't really operationalized itself yet, I think. Although you are seeing LPs, of course, and GPs being a little bit more cautious on defining, for example, an Article 9, where they were more bullish before on Article 9. And now that we've seen there's been a little bit of a backlash from regulators on being too forward on saying something that is green, or being sort of too confident and not being able to back it up with evidence, I think we're seeing a little bit more hesitation of putting your money there unless you can be sure that this actually meets the regulatory requirements. Because a lot of the fundraising that was done on Article 9 was actually done before Article 9 was defined, right? Yeah. So I think LPs are a little bit, everyone is more careful and cautious of being called out for greenwashing. And of course, when you had a German police raid a bank, DWS, last year for essentially, this was an asset manager selling products or mutual funds that they call green, which turned out not to be very green or meet the definition that regulators had. That sent jitters in the entire market, if you like, of labeling or calling something without really being sure that it is indeed meets the requirements.
Yeah, I think there's an interesting time, right? There's a lot of regulation that, are already there, but some of them still being worked on. We're all waiting on what that means.
Yep.
And again, as you said, being a bit more cautious there. Do you see that there's exactly this hesitation right now, or?
So I think what we're seeing, for us, it's a good thing. And our expertise is in demand, our software to help gather the necessary data, share it upwards or downwards. If you're a GP, sharing it upwards with your LPs, or having your portcos report to you, because again, everybody is dependent in this sort of regulatory space. And then when it comes to ESG requirements, you're very much dependent on the quality of data coming from below. So LPs are dependent on GPs are dependent on the portcos, the portcos are dependent on their suppliers. So there's an ecosystem here. And what we're trying to do, is create a better ecosystem where you get bananas and apples when it comes to these ESG metrics. Because right now, there's a lot of sort of there's either a lack of data or there's a lot of poor data. And when you aggregate it, that doesn't help, right? You say crap in, crap out. So for LPs and for others, they're almost entirely dependent on others gathering this data, and they can't really report on this if they don't have this underlying data. And this is SFDR in a nutshell. It's an ecosystem that is required.
Yeah, and how do you see solving this challenge that you mentioned right now, right? So as you said, the poor data or even lack of data, right? Because again, new regulations require new data to be gathered. So
we spend a lot of time on, obviously, one is standardizing this so that when we, for example, speak about emissions, that we measure emissions according to GHG protocol, and that we do this correctly, and including also scope 3, which is quite complex in terms of where does your value chain begin or end, and what categories, how do you do it? There are different methods of doing it. So we think it's very important to have sort of standards for collecting it, but also standards when it comes to frameworks. So something, for example, was mentioned in a panel yesterday about SBTI, which is a science-based target initiative, which is kind of a gold standard for net zero for companies, but now also private equity has guidelines on how to be essentially aligned with 1.5 or with the Paris Agreement. And if we follow these frameworks and standards together, it becomes easier to have data that matches these frameworks. Because part of the problem is that it's not very well defined. So again, we're collecting different data points, we're using different frameworks, slightly different definitions. It doesn't add up. We spend a lot of time and actually a lot of resources from Position Green. We're investing very heavily in our software to keep up with the regulations and also with good practice. So what we see is, having worked with over 500 companies and more than 50 GPs, is the devil's in the details, right? So there's a lot of sort of nitty-gritty things that need to sort of work practically and conceptually for this to come together.
Definitely. I mean, there's a lot of data and a lot of still challenges that we are facing due to the regulations that are coming up, that are already in place. And a lot of people see it as, let's say, a challenge, right? Or a pain, I would even say.
Yes.
But there's hidden opportunity there.
Absolutely. So I think there was a panel before where somebody mentioned it's a little bit like teething, right? With babies getting teeth, or it's this is something you experience with a new initiative or a new industry, new regulation. So we need to get through this, and it's a little bit painful, and the association with it is perhaps more pain than joy, or that it's more a burden than value, more of a cost than value, because there is a cost to get started here. Okay. But I think eventually, this will work itself out, and maybe it's also about adjusting some of the regulation, but this will work itself out. And after a while, when you have this, it will essentially be valuable for all stakeholders. And I think also when we say investors, for those LPs who either invest more broadly or those for even impact investors, have a more narrow definition, and it has to be essentially about net positive, that you're investing in something that actually does good and not just sort of neutral or avoids harm. I think, again, if we have an ecosystem of actually comparing companies and investment opportunities, that's a good thing, because right now it's very messy. People are using different definitions, different metrics. So I think the regulation there is to create a more level playing field, and again, to sort of have apples and apples, and also to avoid, obviously, greenwashing, because up until now you could kind of get away with, either as an investor or a company, saying, I'm green, or I'm impact, I'm this or I'm that. What we're trying to regulate also are the labels here, so that those who are actually green and actually sustainable can do that and go to the market and leverage that, if that's for lower capital cost or access to more capital.
I mean, as you said, right, what actually green stands for, there was like no one definition, and everyone could claim being green, but not knowing really what this being green, what behind that really is, right?
Yeah, and I would add that luckily the regulation that's coming out that is green is actually not just climate and environment, because we also get this question as Position Green, do you just work on climate and environment? No, we work across E, S, and G. So it's very important for us that sustainable is more than just green. It's also about people, it's also about human rights, and we're seeing a greater focus now on both regulation connected to sustainability. So the taxonomy has what's called social safeguards, minimum requirements on human rights, for example. But you also have legislation in Europe which is specifically about human rights and supply chains, so that you as a company and you as an investor, at a minimum, you have to know what is in your supply chain. In the same way that when we measure what's called scope 3, that is emissions in your value chain, not just in your own operations, you also have a responsibility for the way workers or people are treated in that supply chain. So if you're sourcing a material that is extracted under circumstances that are not good or in violation of human rights standards, you need to be aware of that. And maybe you're not able to change that directly, but you need to at least be aware of it and then look for mitigation for this. So I think we're also seeing an increasing focus on people and labor practices, and obviously diversity in the United States is a very important factor in terms of how workers are treated, how you include people. So I think all these factors come together, and we're seeing in the green regulation that these are actually connected.
Yeah, so it's not anymore only environment, it's actually society, because of course all those green policies, all the regulations are affecting environment, but also the entire society, right? So connecting all of that together automatically happens.
Yes. And we have a very recent example in Norway, which is quite interesting. It's a onshore wind park, one of Northern Europe's largest. I think it's actually the largest wind farm onshore in Northern Europe. And it was built in an area where you have indigenous people, Samis, and they have livestock that are impacted by the wind turbines that go up. So on the one hand, it's a very climate-friendly initiative. It's something we need. It's green energy. It makes sense. At the same time, it's having a negative impact, not just on human rights, but on a group that has special protection under human rights. So what happened was that the Supreme Court in Norway actually invalidated the concession. So the wind park has already been built, wind turbines everywhere, international investors, it's already operating. And the question is now, what do you do? Because they say the concession is invalid. The indigenous people, the Sami, say you have to take down the wind turbines. That's what's being said. To add to it, Greta Thunberg showed up in Oslo in a protest, and it got international media attention. So again, it can show that there is tension between what is green or something we think is a good climate initiative if we do not properly consider what is the human impact and have we sort of done our due diligence on human rights. So again, I think these two things can sometimes come in conflict, but they're obviously part of what we would call ESG due diligence. You can't just look at the climate impact. You have to be very diligent at looking at what happens to people or to other stakeholders. Maybe they have a grievance with your project. So I think we're going to see more of this, that this is very closely connected.
High time to realize that, definitely, I think we covered it pretty well. However, I'll just follow up with the question, how is Position Green addressing challenges GP may have when dealing with ESG data, monitoring and reporting?
Yeah. So I think that the GPs are in the middle, right? So they're, on the one hand, they have to report to their LPs, and LPs typically don't send them one report. They all have their own survey. So they have to respond to, if you have 30 LPs, you'll get 30 surveys on ESG.
Different ones.
At the same time, what they're essentially reporting on is the aggregate of their investments in portfolio companies. So this becomes a little bit of a top-down exercise where they're asked by the LPs, then the GPs have to ask the portfolio companies, and the portfolio companies don't always feel that this is very sort of valuable information, or they don't understand why they're being asked this. It's just extractive. And I'm speaking also as a CEO of a portfolio company. We have a private equity investor. So sometimes we get questions or information we have to send up, which is not very material to us, and it's very tedious. It takes a lot of time. So I think sort of GPs are being pulled from they have to just do what the LPs ask for. And at the same time, they have to make this valuable for the portfolio companies, to be able for them to actually collect data that matters to them and that actually makes them competitive, that actually creates value, that can help them make become a more valuable company for employees and for customers. And these are not always the same thing in terms of what they're being asked to report on and what they actually want to spend time on. I think GPs are in a little bit of a difficult position of trying to sort of make this valuable for portfolio companies and at the same time being compliant with their LPs here. But I would also say there's been a huge change in how GPs approach this, because from sort of being more something you pay lip service to, it's becoming very concrete. There's data involved. There are strategies in terms of attracting funding from LPs. They need to have an approach on ESG, and it's becoming more sophisticated because everyone here is becoming a little bit more knowledgeable, a little bit more sophisticated. So when one party ups it a little bit, the other one has to follow. So in that sense, I think it's positive that we're sort of seeing more attention paid to it. It's a little less lip service and a little bit more data and a little bit more substance and sophistication to it. And that's a very good thing.
Okay, perfect. Thank you very much. I want to end up asking you, how was our conference so far?
So far, I've met some really interesting people. And I think that's always the key value of these type of conferences is meeting people. Like-minded or other people who can challenge you. And sometimes you meet people you know from before, and sometimes you meet new people. And I think this has been a very good mix at this conference.
Perfect.
So thank you for having me.
Thank you very much for being here with us.